For decades, the tech founder lifecycle followed a predictable sequence. You build a product in Palo Alto, scale it in the cloud, and eventually sign the exit paperwork in a boardroom on Sand Hill Road. By 2026, that sequence has fractured. The financial logic of remaining in the state has shifted. When you combine a 13% state income tax with rising municipal volatility, keeping your wealth parked in the Bay Area yields diminishing returns. The new capital pipeline flows towards Southern Europe. Jurisdictions like Italy, Greece, and Malta have engineered legal frameworks specifically designed to attract builders and visionaries with low tax footprints and high-trust environments. The objective function for a founder has changed. Securing a buyout is now only the first step. The true measure of a successful exit is finding a jurisdiction where you can legally keep and protect that wealth. This chart plots the core trade-off every founder must evaluate. On the horizontal axis is your total tax burden. On the vertical, global mobility. Silicon Valley places founders in a high-tax, moderate lifestyle quadrant. Southern Europe sits in a different quadrant, lower tax drag, higher global mobility. Securing the European visa is only the final step. The actual hurdle is extracting your intellectual property and corporate entities from the United States. The moment you renounce your U.S. residency, you trigger the IRS exit tax. This assigns capital gains penalties on your global assets as if you sold them all on the day you leave. To navigate this, founders rely on intermediary corporate structuring, frequently using the United Arab Emirates as a base for tax-efficient holding companies. This chart illustrates the required legal sequence. First, pre-exit U.S. tax planning. Second, establishing a transitional corporate entity in the UAE to hold the assets. Finally, executing the European visa for your physical residency. When you calculate the upfront exit tax hit, the cost of UAE corporate setup, and the six-figure annual maintenance for international compliance, the savings diminish for smaller exits. For an exit under $10 million, these legal and structural costs often eclipse the actual tax benefits, making domestic relocation a more sound financial move. Ultimately, migrating your tech wealth to Southern Europe is a highly specialized maneuver. It only succeeds when the mathematics of your liquidity event directly justify the legal complexity of the move.